Assalamualaikum. Hi everyone. We are Group 5. Our presentation focuses on a comparative study of two of Malaysia's largest and most prominent financial institutions, which is Maybank and Public Bank. We will be analyze their dividend policy, tax implication, and investor impact. Before we begin, allow me to introduce the team members: Cik Nur Imanina, Erina Marisa, Izalia Maisara, Nurul Husna, Adriana Sarah, and Kasih Camelia. Now, let's move on to the background of the companies.
My name is Kasih Camelia binti Nazazhan from Group 5. So today, we would like to present about the company that we choose. So for the first one is a company Maybank. This company is the largest financial services group in Malaysia by market capitalization and total assets. So as a universal bank, they offer a comprehensive range of services that include commercial banking, investment banking, and also insurance banking and Islamic banking. For the insurance one is via Etika. So it's a Etika brand. So while the home base Maybank in Malaysia, so Maybank maintains a what we call it a significant regional presence that across Southeast Asia, that called Asian, and they are driven by its M25 plus the strategy that want to focuses on digitalization and the sustainability. Maybank Public Bank Berhad is the name of their company, and the industry sector is a financial services banking. Same goes with Maybank. Maybank also is in the financial services banking. So Public Bank is actually re-owned for prudence and consistent performance that are founded in 1966. So the bank has built its reputations on serving retail, the retail consumers and small and medium enterprise. That rather than focusing on a high risk corporate lending, public bank group, it also maintains the best asset quality in the industry with a low impaired loan ratio, and is highly cost efficient. So the group also operates a substantial unit trust business through its subsidiary public bank network. Moving to the next slide is a financial performance. For the past 3 years, Maybank has demonstrated a strong recovery trends that are following the pandemic, that particularly in revenue growth. So this table shows that how much each year's how much they got for the revenue and the net profit. So moving to the first year, which is 2021, the revenue is 63.51 billion and the net profit is 9.35 billion. So the second year is 2022. It's 49.42 billion for the revenue and the net profit is 7.69. And the last one is 2023, 45.96 billion and the net profit is 8.10 billion. So the reason our group select Maybank because it's widely regarded as the dividend king of Bursa Malaysia. So it consistently offers one of the highest dividends yields in the market. So they also often exceeding 6%, making it a primary choice for income-focused investor. And also to analyzing Maybank allows to examine how systematically important bank balances high cash payouts with the capital requirements needed for regional operations. Public Bank is known for its unbroken track record of profitability and defensive growth. So this table shows that financial result for the past 3 years. So the first years is 2021. The revenue that public bank got is 25.40 billion ringgit for the revenue, and for net profit is 6.65 billion. Coming to the 2022 years, the revenue that they got it 21.43 billion, and for the net profit is 6.12 billion, and the last year is 2023. The revenue is 19.62 billion, and for the net profit they got a 5.66 billion. The reason why we choose a public bank is to provide a strategic contrast to Maybank. While Maybank represents an aggressive high payer, so public bank is a view as a defensive growth stock. So the investor also typically prioritize a public bank for capital preservations and steady appreciations. So to comparing these two institutions allows our group to analyze how different management philosophies and also aggressive yield versus conservative growth impact dividend policies in these industries. So I think that's all from me. A bit briefing about both company background. So I would like to pass to the next presenter. Thank you.
Next is type of dividend policy. Both Maybank and public bank practice a moderate and stable dividend policy. This means they aim to provide consistent dividend to shareholders every year without big fluctuation. Maybank stabilizes its dividend depending on business performance and capital needs, while public bank follow a very steady approach with strong emphasis on sustainability. Overall, both banks focus on maintaining predictable and reliable dividend payment. Next is dividend payout ratio. For company A, which is Maybank, the dividend payout ratio for the last 3 years shows strong commitment to rewarding shareholders. Although the exact percentage changes from year to year depending on profit, Maybank generally maintains a fairly high payout ratio, usually in the range that reflects stable financial performance. This consistent payout demonstrates their focus on providing long-term value to investors. For Company B, public bank has a long reputation for generous and stable dividend. The dividend payout ratio across the last 3 years also remains strong, and public bank is known in Malaysia as one of the most reliable dividend-paying companies. Their conservative financial management allows them to maintain high payout even during challenging economic periods. The next one is type and frequency of dividend. Both Maybank and public bank pay dividend twice a year, usually in the form of interim and final dividend. The interim dividend is normally paid in the middle of the year after half-year financial result, while the final dividend is paid at the end of the financial year. This consistent payment structure allows shareholders to receive return regularly and predictably. Lastly is key factor influencing dividend payout. So the first one is profitability, which includes return on asset. When a bank records higher profit, it has more earnings available to distribute as dividend. Both Maybank and public bank maintain strong ROA level, which support their ability to pay consistent dividend. Second is liquidity and cash flow position. Bank must have sufficient cash on hand before paying dividend. Even if profits are high, weak cash flow may limit dividend payments. This is because both banks have strong liquidity ratio. They are able to maintain regular interim and final dividend. The third one is revenue growth and business performance. If the company experiences stable or increasing revenue, it's built confident to maintain or increase dividend. For banks, stable loan growth and fee income help ensure predictable earnings, allowing them to sustain their dividend policy. Overall, this factor, profitability, liquidity, and revenue growth, play an important role in shaping how much dividend Maybank and public bank can distribute each year.
So now, I will present our analysis of the taxation implications arising from the dividend policies of Maybank and public bank, which is fundamentally governed by the Malaysian tax regime. The first one is adherence to the single tier system. Firstly, it is essential to confirm that both Maybank and public bank operate fully under Malaysia's single tier dividend system, or SDS. The documentary evidence confirmed that all dividends distributed are declared as single tier and are thus tax exempt at the shareholder level. This compliance means the corporate tax paid by the banks, which is currently 24%, is the final tax levied on the underlying profits. This mechanism effectively eliminates the economic distortion of double taxation that exists under the former imputation system. The second one is the effects on shareholder and withholding tax. The impact of the STS on shareholder is distinct and beneficial across the board. Like for resident individuals and institutions, the dividends are received entirely tax exempt. This allows for the maximum retention of cash flows for the domestic investor. Crucially, for non-resident shareholders, both corporate and individual, the system ensured maximum competitiveness. As a direct feature of the STS, there is no Malaysian withholding tax applied to these dividend payments, as our document noted. This makes the bank's dividend yield highly attractive globally, as the investor only face tax liabilities in their home jurisdiction. The absence of WHT will simplify compliance dramatically for both the company and the foreign investor. The third one is company obligation and capital retention. Regarding the bank's own obligation, the STS offers a great degree of naturality. The company pays its corporate tax, and that's the end of the tax liability related to the profit. Importantly, the decision to retain earnings for profit reinvestment is driven not by tax legislation, but by prudential banking regulation. The need for both Maybank and public bank to maintain high total capital ratios and meet other base 1, 2, and 3 requirements override any tax incentive for distribution. Therefore, retained profits are primarily strategic capital buffers, not a function or tax management. Finally, we can evaluate the STS against core taxation principles. The system excels in promoting economic efficiency by removing the tax pressure to distribute profits. This allows Maybanks and public banks to allocate capital based on genuine business needs and regularity compliance rather than tax mandates. Furthermore, the system upholds simplicity by establishing a clear single status of tax exempt for dividends and eliminating withholding requirements. The administrative burden is significantly reduced for the banks, and the complexity of tax compliance is minimized for all shareholders. In conclusion, the STS provide an optimal tax environment for both Maybank and public bank that supporting their capital adequacy while enhancing their attractiveness to both domestic and international investors. That's all from me. I'll give it to the next person.
Hi, Assalamualaikum. My name is Nurul Husna, and today I will be explaining recent dividend announcement for both company, Maybank and public bank. So first of all, the source of information for both company are from Bursa Malaysia. So now I will be focusing on Maybank first. So date of declaration for Maybank is 26 August 2025, and this declaration was made in conjunction with Maybank's quarterly financial result release. Amount of dividend cent per share is 30 cents per share, and this is the first interim dividend. It is a single tier dividend which is tax exempt at shareholder level, and how to calculate is for example 1000 times 0.30% is 30 cents, and it will equal to 300 ringgit. For the payment date, it is 26 September 2026, and Bursa Malaysia requires company to disclose the ex-date and the entitlement date, which determine who qualifies. So the impact or reaction on the share price. So before the announcement, which is 25 August 2025, the share price is 9 ringgit 85 cents, and after announcement, which is 26 August 2025, it is 9 ringgit 75 cents. So it has 1% drop, and this represents the typical dividend pricing mechanism rather than negative sentiment. So dividend payouts are already anticipated by the market. So now I will be explaining for the public bank. So the date of declaration is 26 August 2025. This is the most recent interim dividend announcement for the year, and the amount of dividend is 10.5 cents per share, or 0.105 cents ringgit. So earlier in March 2025, public bank declared only 11 cents previously, and high payout ratio. It is a high payout ratio, but smaller per share dividends. For example, how to calculate 2,000 ringgit times 0.105, it will be 2,100 ringgit. So the payment date, it is 2 days earlier than Maybank, which is 24th September 2026, But for the March declaration, the dividend payment was on 24th March 2024. So the impact or reaction on the share price before the X date, it is 4 ringgit 50 cent, and on the X date, it is 4 ringgit 40 cent. So it has 2.2 drop, and new buyers no longer get dividend on the X date, and this shows a stable investor base and reflect normal dividend pricing behavior. That's all for me. I will pass to the next presenter.
Hi, my name is Cik Nur Imanina and I will be presenting about analytical insights. These sections provides the group's analytical assessment, answering the crucial question, which is what risk does each policy carry and which investor profile is targeted. First, we have policy risk level. We see a fundamental divergence in risk strategy. Maybank's policy is moderate to aggressive. Their high payout ratio consistently around 17% is great for immediate income, but inherently carries higher risk. The aggressive payout means they have less retained earnings to absorb economic shocks before having to cut the dividend. In contrast, Public Bank is conservative and safe by maintaining a stable payout near 57%. They prioritize capital strengths, leading to their famous resilience and low 0.5% growth in period loans ratio. This makes their dividend extremely predictable and low risk. Next, taxation influence. Why Malaysia is competitive? Both banks benefits from Malaysia's single-tier dividend system (STS). This is key because the dividend received by any shareholder, local or foreign, is tax exempt, solving the problem of double taxation. Furthermore, the absence of a Malaysian withholding tax is a massive advantage for us as a country. The main constraint on dividend size remains the need to meet strict regulatory capital ratio, like PBB's total capital ratio of 17.1% before distribution. Next, investor impact, local versus foreign. This is where the two policies define their audience. For Maybank, local investor, it appeals strongly to income-focused institution and retires due to its superior 6.0% dividend yield. They are prioritizing cash flow. For foreign investor, they are attracted by the high yield, which is maximized because the full amount is repatriated without a Malaysian withholding tax. For public bank, local investor attracts conservative long-term investor who prioritize capital safety and stability. They view the lower payout as prudent internal reinvestment. For foreign investors, PBB is often bought by defensive funds looking for rock-solid stability in Southeast Asia. The constant payment combined with the tax-exempt status ensure the quality and predictability of their foreign cash flow. To conclude our analysis, Maybank should use its dividend investment plan (DRP) more often to retain cash during growth periods, and for public bank should provide formal minimum payout guidance to enhance investor transparency. That's all from me. I will pass it to next presenter.
Hello everyone, my name is Sarah and I will be presenting the comparison and conclusion for our analysis of Maybank and Public Bank dividend practices. To make the comparison clear, our group prepared a side-by-side table that looks at four main criteria. The first one is dividend payout, frequency, tax effect, and investor impact. Firstly, in terms of dividend payout, Maybank offers higher payout ratio ranging from around 77% to 87% over the past 3 years. This shows a more moderate to aggressive approach. As for Public Bank, on the other hand, maintains a more moderate and stable payout between 53% and 57%. This means Maybank generally gives out more of its profits as dividend, while Public Bank focuses more on consistency. As for dividend frequency, both Maybank pay dividend twice a year or semi-annually. So in terms of frequency, they are the same. Moving on to tax effect, under Malaysian single-tier dividend system, the tax effect is also the same for both banks. Dividends are tax exempt for resident and non-residents investors, and there is no withholding tax. And this makes both Maybank and Public Bank attractive option, especially for international investors. Lastly, investor impact. For investor impact, Maybank is more suitable for investors who want higher income through larger dividend payouts. And for Public Bank, it's more attractive to risk-averse investors who prefer long-term safety and stability. Local investors may choose based on their goals, while foreign investors appreciate both due to Malaysia tax structure. In conclusion, both banks have strong and reliable dividend strategy, but they serve different investor needs. Maybank is better for investors who prioritize high dividend income because of its higher payout ratios. Meanwhile, public bank is ideal for those who prefer stability and lower risk due to its consistent and conservative approach. So the better dividend approach depends on the investor. Choose Maybank for higher returns and choose public bank for long-term stability. Thank you.